Hi, I'm Steve LaFrance with Blakely Financial, and I hope you had a wonderful Labor Day weekend. Markets took a small breather last month with the S&P down 1.6%, Dow down 2%, Russell down 5.1%, NASDAQ down 1.5%, and corporate investment grade bonds down 1.2%. Energy was the only sector to trade higher, while the remaining 9 sectors traded lower. That said, markets and yields remain firmly in the positive for 2023, with the S&P up 18.6, the Dow up 6.2, Russell 2000 up 8.8, NASDAQ up 42.3, and corporate investment grades up 3.1% with a current yield of 5.7%. Last month's pullback occurred as investors worried about the potential for further interest rate hikes at one of the remaining 3 meetings this year. Let's come back to this. A couple key data points grabbed our attention in recent weeks. First, the number of U.S. job openings fell below 9 million for the first time since March 2021, with separate data showing fewer employees voluntarily quitting their jobs. This suggests the tight labor market is improving and may help ease wage inflation. Second, consumer sentiment weakened due to higher borrowing costs and lingering inflation concerns. Markets are also digesting last week's employment situation report from the U.S. Bureau of Labor Statistics. A total of 187,000 new jobs were created in August, higher than the 170,000 expected, but remain below 200,000 for the third straight month, which is consistent with a cooling jobs market. The unemployment rate ticked up 30 basis points to 3.8%, which is higher than expected, but the labor force participation rate, which had been stuck at 62.6 for the last several months, grew by 20 basis points. This means more people are rejoining the workforce and is now at the highest level since pre-COVID. It's also why the sudden jump in the unemployment rate is not so concerning. So back to August's pullback and what comes next. With the mild turn in employment data and the continued success in the inflation trend, many think the Fed will not raise rates at the September meeting, and borrowing any radical change in the data may not do anything in November either. As I mentioned last month, expectations continue to drive this market, with investors hopeful the Fed can achieve a soft landing or potentially avoid a recession altogether. Not much has changed from that perspective, and we'll continue to keep an optimistic eye on how everything comes together. That's all for now. Thanks again for your trust and confidence.